Kevin here, top 100 financial advisor, two-time author, one-time bestseller, and we are here to talk about the stock market. We have taken on some losses, at least in the last 2 days, but I want to help assuage those fears. That's my new vocabulary word for the day. And show you that it's not that big a deal, but also show you how to protect yourself when the market does things like this, but also explain like what happened and why. So let's go ahead and get into it. First, this is the Investors Toolkit. You do want to check it out. It is the easiest, simplest, step-by-step investing course on the planet, period. But also, I help you to learn how to start investing. And let me turn my hat around because it messes up the light. I help you to start investing, but also help you to avoid bad investment decisions. For example, we know that on average during the coronavirus, which was the most recent recession, that the average investor lost $22,000 per person. You do not have to do that. We can't prevent losses altogether, but I'm pretty sure we can, put a cushion or lessen that a bit, which we can do. And I'll show you how to do that, a little bit of that today. Also, because you guys asked, and I am a man of the people, you guys asked about like having a payment option and coupons or things of that nature. We actually do have a payment plan. If you scroll all the way to the bottom, I don't know why it's at the bottom and at the top, but you can break it up into 3 payments too, if you choose to do that. Now, let's go ahead and get right into it. Number one, why did the market fall? Some of this is because of people chasing or hot money chasing. People jump into stocks because it's hot and don't know nothing about it. This is the same theory as to why people lose money in stuff like Kodak, but also because of the buzz around the splits for Apple and Tesla, tons of people jumped in it, they got their money, and tons of those people jumped right back out. Now, if you're a long-term investor, which I suggest you should be, it's not that big a deal. Over the long term, you're going to be fine. However, there is something you need to know. And pause, time out, right quick, because I'm talking too fast. Hit the share button now, right now, because what I'm about to say is going to be extremely important, and it's going to help get you prepared for what could happen over the next few months. Share it right now. I'm going to go back right quick and talk about it. All right, so number one, why has the market fallen over the last few months? Because of hot money, people jumping into hot tech stocks and hopping right back out. But generally, September tends to be one of the worst months in the year for investors. But in an election year, which is this year, October and November tend to be even worse. Now, I'm not saying that we're going to go all the way back to where we were in March. I don't know how severe this is going to be, and it is still coronavirus. So all types of weird things could happen between now and December. But in general, October tends to be really bad, and November tends to be pretty bad too. So do expect that, do be ready for that, and learn how to protect yourself. How do you do that? Number one is the Investors Toolkit. Number two, I'm going to get into that in just a few minutes. Now, number two, as to why the market fell, a lot of people are blaming SoftBank, their Japanese bank, that bought $4 billion of options. We had talked about options in a previous series of videos about 2 weeks ago. One option contract controls 100 shares. If you buy $4 billion of contracts, you're talking, millions and millions of shares that you now control. And when you move that type of money, it gets people like me and other traders and all these people excited about it. So they start buying because they saw SoftBank or somebody else do it. In the same way that we see, Warren Buffett did this thing and everybody jumps into it. People did the same thing with SoftBank. So when they start to buy options and people start to notice, then the market reacts. And this time it didn't react in the way that most people would have expected. Now, how do we get into protecting ourselves? How do we prepare for what may come over the next few months and weeks? I'll show you. So this is my portfolio on public. As you guys see, there are 12 stocks here. Most of them are in tech. We can discuss whether that's a good or a bad thing. It's probably not the best thing in the world. But I want to show you how to protect yourself and what you should do in situations like this and what you should do on a regular basis anyway. That is a terrible drawing of the market. I'll get into that in a minute. But I want to erase this because I tried to do this earlier and it just didn't work. But we're going to do it right now. All right, so these are the stocks that I own. And if I have $1,000, what I would try and do is have $83 in every stock that I have. This means I am even. Now, also, before I continue here, I probably should have I have a lot of tech here, but I should probably diversify this a bit more. I don't have in this portfolio, I have it in other accounts. In this portfolio, I don't have the consumer stuff. I don't have Target, don't have Walmart. I don't have a lot of that. But I got healthcare here. I had pizza here. I've got auto repair, and then I've got medical, a bunch of stuff there. I could probably use some more things to kind of even me out. But for example, let's just roll with it. So I got $1,000. I'm splitting everything up by $83 a piece, so I can be even. I am balanced in this scenario. Now, some people will say, "Well, what about the shares? Like, shouldn't you have 5 shares here, 5 shares there?" No. The reason why you don't want to do that is because the share amounts are going to vary. For example, Amazon is $3,000 plus a share. That's going to throw everything off. This one share is more than I have in my entire account. So that's not going to work. But also a stock that's $3,000 a share, well, Microsoft is only $200 a share. How am I going to do the math to figure all that out? I don't have time for it. Because then what you're really doing is saying, well, you need 0.25 shares or whatever it is of Microsoft for every 1 share of Amazon. That's not going to work. Nobody has time for that. That's why it is important to have fractional shares or have an app that allows you to do fractional shares, because I can easily say $80 for each of these and just keep it simple. And as the market grows, we can say, all right, well, now we're at a point where we can have $100 share, $150. I'm sorry, not per share, per company, $150, $200 for each one of these, and I can keep this even. Now, this process, though, needs to happen no more than 1 to 4 times per year. And the reason why I say that is because, again, these move every single day. Monday through Friday, they're moving. You're not going to be able to come in here and make changes every 10 minutes. It's not that serious. You can also have what we call drift. So let's say that you're at $83 and then it kind of gets to 90. That's fine. You're at $83 and gets down to 80, maybe $78. That's fine. It doesn't have to be exact, but you want to make sure, again, that you're even. Also, if you have a company, let's say Johnson & Johnson, that shoots up to, I don't know, $500, you can also say on the day that you specify, well, look, you know what, I'm gonna come in here, I'm gonna sell some of this and put them into those that are not at, $83. Let's say this one is at 80, I'm gonna put $3 here, I'm gonna put some here and put some here. You wanna go and take some of that and go and even it out and put it in all the buckets so they are as close to even as possible. The reason why you do this, erase some of these lines. The reason why you do this is because in any scenario, if something doesn't go your way, it doesn't drag down all of your stocks. For example, Google, one of the best tech stocks out there, they're going through an antitrust suit. So if I just let this ride and I've got, let's say, $800 in Google and just $5 in all the rest of the stock, what if Google doesn't do well because of the antitrust suit and they fall off the map? Guess what? That's $800 of my whole 1,000. That's a lot of money in one stock that's gone. That's not a way to protect yourself moving forward. And we had already talked about, yes, you want to have some tech, but you also want to have things in different areas too, so that when the market falls, you have some sort of cushion or protection to help you bounce back so you're not losing as much when things don't go the way that you expect. Especially in a time where we're talking about an election year, there are going to be politicians and rules and things that people throw out there to say, hey, we need to break up big tech. We need to regulate big tech. Well, guess what? You got too much big tech. You are not going to be happy about that and what that may or may not mean for your particular portfolio. So having a little bit of diversity, flavor in your portfolio is going to help you. So that is one way that you can protect yourself, is by knowing how much do I need to have in each of these. Don't pay attention to the share count. The number of shares don't matter. It's how much money you have in them. And you want to be relatively even, unless you're trying to purposely, what we say, overweight, and purposely have more money in Apple, purposely have more money in Microsoft than anything else. Most people do not do this, and this is why people get burned. If you had so much of your money in Apple and you weren't paying attention, Apple fell like 7% over the last 2 days. You're not happy now because you had so much money in Apple that you weren't paying attention to everything else. Everything in the market hadn't fallen off the map. Not everything. It was just mostly tech, which drags down everything else. But you can have everything. I keep saying everything. You can have these stocks evened out a bit and cushion you when the market starts to act a little strange. Now, one other thing people are going to ask, if you know that September tends not to be good, if you know that October really ain't going to be good, and you know November is probably not going to be great either, well, what do you do? Is now the time to invest or is it not? My answer has always been the same. You want to remain consistent. But here's the thing. Here's the thing that we need to talk about the most. The same people that say, well, I'm going to buy on the dip. I want to buy because it's low. You really probably don't know what you're talking about. And the reason why I say that is because what is low now was low 2 weeks ago and you didn't buy then. So I want to show you exactly what I mean by that. Let's go here and let's see this right here. All right, so this is the S&P 500. This is from now, today anyway, all the way back to July. This was a pretty steep dip. Let me move. Hopefully, I don't know if you guys can see when I move the screen, but right now the market fell. Everybody's upset. Oh my God, you know, from the second to now, the last 2 days, we took a huge dip. And people are saying, well, I'm gonna buy now. I'm going to buy the market now because it's low. Well, if you trace that line that goes across here, we're at the exact same level that we were on 8/24 on Kobe Day. Why didn't you buy then? The market was low. The market was low, but because the way we think about it is, well, it was going up, so you know, I don't know. Like people, they don't know. So this is why you get in on a regular basis. First of the month, 15th of the month, twice a month, whatever it is. This is why I have a systematic process. When I invest, I'm investing on a consistent schedule. When I check my investments, which I told y'all are like quarterly, and why I put out my watch list and make those changes like twice a year, this is why. Because what you think is low today was literally 2 or 3 weeks ago. It's almost the exact same thing. So don't get caught up into what you know, how we feel about the market. Your job, stay consistent and protect yourself by making sure your investments are even. That's all it actually takes. That's all it actually takes. Because remember, the people right now that say, I'm gonna buy on the dip, they weren't saying that on 8/24. So pay attention to that. Make sure that you are protecting yourself and make sure that you are consistent. And like I've always said, those who are investing now are going to be the ones that are going to be wealthy in 2030 and 2040. The same way I say that those who were investing in March were going to be the ones that are up today. And they are. I don't know what's going to happen if we're going to go, you know, back to March levels by November. I hope not. But even if we do, every 2 weeks I'm putting money in anyway, because I know, and we all know, that the market over time does tend to rise. So you are going to be okay. You do want to make sure you are diversified and balanced. This is what we call rebalancing, is what I'm showing you here. And all it takes is, number one, you knowing how much money do you have in each of those stocks and how can you tend to even those out. But also have some money in some bond funds, have some money in some index funds too. Index funds are the only one where I would say, you know, you got $83 in all of these, you could put $900 in index fund because it owns all of them anyway. So hopefully that wasn't too much today, but I did want to show you guys context. Context is always so important, and it can help you to survive crazy times like this. So make sure that your individual stocks are balanced. Make sure you have your buckets in order. You don't want to have one bucket have all the water and the rest of them have nothing, because when you're thirsty and you spill one of them, you got the rest of the buckets there. And then also don't buy into the, well, I'm gonna buy because it's cheap. Well, it was cheap 2 weeks ago, so you should have gotten in then. Why didn't you get in back then? But the easy way to do that, because you're not going to be able to time it, is just put it in regularly. Whatever your schedule is, payday, whatever day, just put it in and keep it pushing. That is the best way for you to make money over time in the market. All right, so that is it for me today. Also, make sure that you check out the Investors Toolkit. And if you have any questions, please put them in the chat below and let me know what you guys think. All right, I'll talk to you guys later.